one of the things that investors are going to want to look at as far as that goes is how the bank is managed, how they're approaching the low interest rate environment, and whether they're prepared for an eventual turn. Now, some of this is a little tough to pick apart, and you really have to get in depth into some of the financials to really figure out what these banks are doing. And in some cases, the information just isn't available, like really detailed information on the duration of the bank's portfolios. And when I talk about that, that means, banks don't lend a 30-year fixed mortgage and then have that 30-year fixed mortgage sitting on their balance sheet for 30 years. They have a variety of different securities and loans and everything else that are kind of on an ongoing basis. It's sort of like a waterfall that some falls off today, some falls off tomorrow. And if you take that and smush it all together, you have this overall duration of the portfolio. And when interest rates, when spreads are low like this, what banks want to do is kind of shorten the duration and be prepared for an eventual turn when spreads widen back out. The risk is that if they're not prepared for that turn, then they kind of get turned upside down. And we saw a lot of this way back in the past in former banking crises. They usually started with a rise in interest rates and banks not being prepared for it. So there could be some pain for banks when that turns around. What we're seeing right now, and I focus a lot on the biggest banks because that's what a lot of our readers are really focused on, we are seeing them prepare a little bit for it. And one way you can look at that is loan to deposit ratios, so the amount of the deposits that the banks are actually lending out. So if they've got, say you've got $1 trillion in deposits and you've lent out $1 trillion. That's sort of, in normal times, that's a reasonable ratio. But now what you're seeing is they're lending out less of the deposits. So you've got, on $1 trillion of deposits, you've got $800 billion of loans, you've got $900 billion of loans. So you've kind of got this buffer space that as margins start to widen back out, they can take advantage of a little bit and hopefully get hurt a little bit less. But I think that's what investors want to look at when you talk about the big picture, which is the right way to think about it. Eventually it will turn, so you'll kind of have this little bit of a painful, difficult time right now. Probably be a little bit continue to be difficult as the environment turns, but then once it turns and margins widen back out, it'll be a much better environment for these banks.